Economic Outlook session, and we're very pleased to have Anna Wong. She is the Chief United States Economist at Bloomberg Economics, and she's here today to give us a detailed look at the current economic situation. Also joining her is AACC board member Laura Belden for this interactive session. Anna, please.
Thank you. Anna is really wanted to have an interactive session today because there are so many questions about the economy. So before you think of a next question, I want to ask Anna to share about what you think about the U.S. economy and the global economy.
Okay, thank you for having me here. It's a pleasure to be here. So I think to talk about the economic outlook, we first need to figure out what is really happening to the U.S. economy, because it seems like in the present situation, half of the population can't even agree with the other half on how great or how bad is the U.S. economy. So if you go by the news headlines you read every day in the media, including from Bloomberg, the economy is doing awesome, right? GDP growth, Atlanta Fed has a nowcast, which is tracking GDP growth in the third quarter to be 3.4%. Retail number came out this week, and it was very strong. Payrolls in the last month was showing 250 for jobs created in the previous month. Inflation has come down to 2.4% after peaking at 9.1% in June of 2022. And so it seems like soft landing is at hand, yet more than half of the Americans think that a recession is currently happening in the economy. More than half of the Americans think that their financial situation is in dire straits. So what's really going on? And you know, my clients, so I served in the public sector for over 10 years before I joined the private sector, so I'm the opposite of Juan Pablo. So in my past 10 years in the public sector is all about writing talking points for policymakers. But now on Wall Street, what my clients are more about finding the edge, right? Finding what people are not seeing, because only by finding the edge can you make profits in the financial market. You have to figure out what's not priced in. So what's not priced in the market, which is what are people not seeing about the economy that's really happening. So this is what. So this is why it's important to drill down into the details. So if you look at the details, what you find is that things are not so great. Credit cards and auto delinquencies are at levels last seen in 2010, 2011. Bankruptcies of firms has now risen to the pace last seen in 2012. The bond market just a month ago was pricing in 50 to 60% chance of a recession, even though the equities market is partying like there's no tomorrow. So you know what really matters for the economy is the labor market, because you can talk about housing wealth, you can talk about equity wealth, but what people really have as an income source is a job. If you lose a job, your job, then everything just goes down the drain. So looking at the unemployment rate. So unemployment rate has risen throughout this year from a low of 3.4%, now it stands at 4.1%. And in economics, there is an empirical regularity that says whenever the unemployment rate rises by 0.5 percentage point within a year, then it suggests that the recession is coming. So that rule has triggered this year, and the reason why most people still think, at least most people on Wall Street still think that a soft landing is guaranteed, is that they think this empirical regularity will break. Our view is that not so fast. The cracks we're seeing in the labor market are we see that fresh college graduates unemployment rate are at the level last seen in 2010. And usually from, if the labor market is strong and healthy, you would see hiring very strong. And yet the fresh grad from college has a very, very, very hard time finding a job right now. And that is usually a telltale sign of something that is not great. Another type of people who's experiencing difficulty in the labor market are those people who don't currently have a job and who are in industries like tech and white-collar industry. And that's because during the pandemic years, a lot of the large companies like Meta, Amazon overhired white-collar workers, and now they're still going through cost reduction even after 2 years of layoffs. We're about to enter into a layoff season, and typically layoffs tend to spike in December and January. So we are expecting that we're going to see another wave of layoffs in the coming months. So where does that put us on the unemployment rate? So we do think that the unemployment rate will likely continue to rise this year to 4.4 to 4.5%. And next year, it will peak at 5%. And whether people think that is a recession or not, it is really a meaningless debate among economists, because ultimately it would be an academic business cycle data committee that will determine whether there will be a recession 2 years from now. At which point the recession is probably already passed and nobody cares already. But from a Wall Street perspective, from the bond market perspective, if unemployment rate does surprise to the high side, so currently the consensus see the unemployment rate peaking at 4.4% this year and going no further. So if the unemployment rate does rise beyond 4.4%, what you're going to see is that the 10-year yields and 2-year yields will plunge, because that will be a surprise to them. Now, what does that mean for the housing market? So the housing market more is tied to the mortgage rate. So currently, housing affordability, which is another factor in the economy that's causing widespread pessimism, because people who don't have a house could not buy a house, and there's this generation of young people who could not have a hard time forming a family, because you need a house and to expand your family. So it's again one of those issues of, do you already have it? If you don't already have it, you are very unhappy. So the mortgage rate right now at close to 7%, and also a high level of housing price has meant that the affordability issues is worse in over 40 years. And we see that even though the Fed is starting to cut rates, the Fed cut rates by 50 basis points in September, which we predicted. And we're expecting the Fed to cut another 25 bips in November, and another 25 basis point in December, and another 100 basis point next year. So by the end of 2025, federal funds rate will likely be at 4%. So 4%, but that assumes that inflation does not come back up, and I will talk about the risk to that inflation outlook. But focusing on the housing sector for a moment. So a 4% Fed funds rate would still be associated with about 5% mortgage rates. So that is not low enough to generate another wave of refi, or 5% is still pretty high. And it's even possible that given the shortage of single-family homes, that home prices will re-accelerate again next year. So what does that mean? It means that I think the housing sector, housing will still continue to be unaffordable for a lot of people, and that would be a source of unhappiness. And so I would not expect the housing sector to be a source of positive driver, a strong impulse for growth, even as the Fed starts to cut rates from now to the end of next year. On inflation outlook, as well as growth outlook, I'll just name a couple of risks that I see in the horizon. So geopolitical risk. Markets are very bad at pricing geopolitical risk, and so geopolitical surprises has the greatest potential to lead to fluctuations in financial markets. As a former policy official in both Democratic and Republican administration in my past, I would say that there is a agreement between both Democrats and Republicans, even though it doesn't seem that they agree on anything. What they agree on is the geopolitical risks posed by China. And these policies actually will persist throughout, and I think that under either Harris or Trump in the next 4 years, the risk related to China and how and what kind of policies escalation they have will be pretty impactful on the financial markets. And in terms of the economic situation for China and other of our major trading partners like Germany, Canada, right now all three of them are not doing well. Canada's unemployment rate is close to 6%. China's housing market, by my colleague's estimation, required another 10 years to clear the excess housing supply. This time it really is different in China, that the pessimism over the housing market is causing a dampened consumer pessimism that is hard to shake. Germany, in turn, is always the first in line to be negatively affected by China. So whenever China slows, regardless of whether you believe in China's data, you could easily see whether it's slowing from what Germany is doing. Because Germany has a very strong trade ties with China, and every time China's manufacturing production slows, you see Germany being hit. And in turn, that has to affect equipment investment in the U.S. And our estimation is that for every 2% GDP growth slowdown in China, that could affect slow U.S. economy down by about 0.5 percentage point. That's our estimate at the Federal Reserve when I was there. So another risk going forward, of course, is the election, U.S. presidential election policies, Harris versus Trump. And I will talk a little bit about that. So the policy proposals of Harris and Trump sound really, really different. But again, when you look at what's going to be plausible under the most likely scenario in the Congress, and also what they likely will do, in fact, the difference on inflation, on growth is not that big. There is one commonality, though, which is that both of them are not fiscally conservative, and that government spending, federal debt to GDP ratio will very most likely rise under both candidates. So we estimate that the fiscal debt to GDP ratio will rise from about 100% of GDP today to roughly 140% under either Harris or Trump. 140% by 2034. So under Harris, for example, she proposes to raise corporate business tax, and the expiration of Tax Jobs and Cuts Act will automatically raise the personal tax rates of everyone, but both Democrats and Republicans agree that those who are making under 400,000 should not see a tax increase. So very likely, either winner will extend the tax cuts under texture, make them permanent for those making under 400,000. The key is what's going to happen for those who are making over 400K, and I'm sure many of you fall into that category. So it's more likely that under Trump that those tax cuts would be extended. However, something got to pay for it, and that because those tax cuts will be costing multiple trillions over 10 years. And under Trump's proposal, much of that revenue raising would be coming from tariffs, which that proposal estimate will provide over $3 trillion in revenues. But so having worked in the White House during the Trump administration in 2019 when I was seconded there from the Federal Reserve, my view is that former President Trump does not see tariff literally, and you should not take his word literally from when he says he's going to slap 60% tariff on China and 20% on the rest of the world. He really sees it as a means of negotiation, and it's kind of like, in Asian culture we talk about face saving, right? he is about that. He's trying to get, by the end of 2019, the former president was actually agreeing that trade tariffs, actually the uncertainty over tariffs is generating negative impact on the manufacturing sector of the economy, and that was why in December 2019 he decided to take that deal with China. And unfortunately that was disrupted by coronavirus. So my view is that with this, if he were to win, he is going to finish what he started. I mean, Joe Biden wanted to do that, to finish what usually second-term presidents want to finish what they started. And I think from his perspective, the job he has to finish is that deal with China, and that he's seeking that face-saving middle ground, and he is actually not an ideological person. He would be totally in for a deal. So this is the reason why I don't think that the actual tariff, even if Trump were to win a second term, would be as crazy as what he said he is. However, let me get back to the fiscal situation. So under both Harris and Trump, the fiscal situation is going to be worsening. So who's going to stop them? Either of them. That would be Wall Street. So the last time we have seen these guys called bond vigilantes was in the 1980s, and what they do is, if the federal government is fiscally irresponsible, these guys would drive up 10-year treasury yields, forcing the economies to slow down, forcing the government to reckon with the fiscal situation. And while bond vigilantes have been a familiar sight in emerging markets, they have disappeared in the U.S. in the past 40 years. So I do think that if they do make a reappearance and drive 10-year yields to over 4.2% right now, I've personally observed that whenever 10-year yields is above 4.2%, you will start to see clear signs of slowdown in the U.S. economy. Because when you think about it, the Fed cuts rate by 50 basis points in September, yet 10-year yields have risen significantly since that 50 basis point cut. So essentially, the economy, financial conditions in the economy actually tightened rather than loosened since the Fed cut by 50 bits. So if the bond vigilantes were to keep driving up 10-year yields, it means that the Fed is sort of losing its impact on driving financial conditions on the economy. So it is as important to watch what's going on with the 10-year yields as predicting what the Fed's next move is, because if the financial market thinks that the Fed is losing control over inflation, then it means that the Fed's ability to land the economy and soft landing has decreased. So I think that to me, that fiscal situation and whether bond vigilantes will drive 10-year yields higher is one of the most acute risks I see in the next year or two. In terms of how a Trump administration win is being priced in the financial market, there's a thing called Trump trade. And a Trump trade in Wall Street is basically betting that inflation will rise in about a year's time. And also on the idea that the fiscal debt will balloon, so also betting on 10-year yields will rise. So I think whether that is true or not, it is a perception, and that perception is what drives financial market. So I think in the short term, from not talking about the connection to what the policy actually have in reality, but about the perceptions of what those policies would do to the economy, I think in the rest of the year, the Treasury yield would look likely to be going up, especially if the perception of a Trump win were to increase. So I think I will stop there.
Very well. That was my one question. So we have a couple minutes to, answer maybe 15 minutes? Okay, we have 15 minutes to probably answer a few questions. Anybody has any questions here for Anna about the economy?
Thank you. Thank you for sharing very insightful views and very informative. I have a question. You mentioned that labor is one of the most critical factors for the economy. So with upcoming AI to the marketplace, hopefully, in the next 3 to 5 years, how the economic theory will be modified in the sense of how AI will help or at some extent damage the economy in the long run. Just very curious to know your view.
Yeah. So AI technology tend to boost productivity in the longer term. So the question is, have we seen the productivity gains from the AI already? Has it started, or are we yet to see it? So the most important thing is that before you get to that productivity gains, you have to have cost reduction. And in the internet boom in the 1990s, first you see actually a wave of layoffs related to excess labor due to the efficiency from internet. And I think we have barely seen this. I mean, we have seen some layoffs related to AI in tech industry, but in order for the productivity to be widespread in the economy, first you need to see that layoffs, the cost reduction from AI affecting all the other industries, not just tech. For example, an example is the port strikes that we saw on October 1st. One of the point of argument of those union workers is whether the ports are switching to automation. I mean, in China's ports, they're using automation and AI, and however the unions are demanding, a 50% pay raise and stop that AI. So there are these structural forces in the economy that's impeding the AI in generating cost reduction. So we have barely seen the necessary adjustment in the economy to generate that productivity gains.
Thank you.
So most Asians were very conservative about debt, and the United States took on a lot of debt. And you mentioned that under either administration, the fiscal situation is going to get worse. But I've heard people say, "Don't worry about it. The Fed can print money." So I'm just curious, what's your take on that? How concerned are you about the situation?
Yeah, oftentimes, sometimes people will come to the right answer, but for wrong reasoning, and that would be one of those. So, in fact, worries about the U.S. fiscal situation has persisted over decades. I remember when I first started as an economist, we were wondering in 2010, from the QE whether inflation is exploding and whether remember back then John Boehner, fiscal cliff, all that sequestration stuff. Ultimately, we're fine, right? So why worry? Well, I think so. In the past, the thing that has been keeping this debt to GDP ratio from exploding is the willingness of foreigners in financing U.S. debt. Partly, we're talking about China purchasing U.S. treasuries, and also Japan purchasing U.S. treasuries. And Japan now is increasingly bringing investment back home because finally inflation is moving in Japan, and they could raise interest rate there, and that could lead to less Japanese demand on U.S. treasuries. Of course, we have escalating tension with China, and China has been diversifying away from U.S. Treasury for a period of 10 years already. So I think right now we can count less on foreigners in financing U.S. debt, and as a result, the interest rates on U.S. debt could be rising, reversing a 20-year period where Treasury yields were just on a secular decline. So that is one force against the interest payments, against providing favorable interest payments. And as you know, what forced Americans to stop spending is when they see the interest rate payments on their credit card ballooning. Then that's a force to stop one from spending.
Thank you. That was really impressive what you said. We're all sitting here nodding our heads after you went through the presentation. Going, wow, that's the best I've heard from anybody, so I compliment you on that. I'd like to go back to the issue on tariffs. And I want everybody in this room to understand when you talk about, they're talking about, well, if Trump goes ahead, if he gets elected, and he's going to slap tariffs on everything coming, it's going to be a tax on the American public. It's not really a tax. Okay, let's just clarify that right away. And I'm not here to defend it, but how it works. I owned a custom brokerage business. This is how it works. So anybody in this room who imports any goods into the country, you register with your customs broker. You have to have a bond, a customs bond with it. You are officially the importer of record. You will be assessed the duties and the taxes on what's coming in as the importer of record. That's not being sent back to China, Brazil, Japan, Korea, whoever. That's going to the importer of record. The importer of record has to make that decision. Am I going to absorb it, or am I going to pass it on to my customers? And I can guarantee you that 99, 95% of them are going to pass it on to their customers.
Yeah.
So it's an increase. So what they're missing the point is that when you talk about raising tariff, what you want to do is make it so expensive to bring products in from a foreign country that American consumers are just not going to buy it. You know, it's like Trump saying when the Chinese are going to build cars in Mexico, we're going to make it so expensive for those cars to come in there, nobody's going to buy a car coming in there. So the issue is that you have to understand that, yes, it'll be increased in cost to the average American. Now, there's a lot of items that come into the United States that are duty-free. We have trade agreements that are out there. All those would have to be negotiated. You got to be ones to slap a tariff on it. There's also retaliatory tariffs from our trading partners. So with all due respect to our ambassador from Malaysia, but I guarantee you, if we slap tariffs on stuff that's coming in from Malaysia, the Malaysian government's going to turn around and go, you know, I think that we should be able to slap this on to you if it's coming back. And the best example I ever heard was when Trump was president. If you all remember this, he slapped tariffs on the Europeans on wines and cheeses coming in from Europe. What did the European Union do? They go, wow, that's not good. Maybe we should take a look at what's really important. So what did they go after? Let's take a look at bourbon from Kentucky. That really made Mitch McConnell really happy when all of a sudden bourbon exports to Europe just dropped like a stone. And talking to the bourbon manufacturers, they manufacture and they ship to Europe bourbon in specialized bottles that only you can sell in Europe, but you can't sell them here. So you got all this inventory of bourbon bottles and they're just sitting in warehouses and can't go anywhere. So be careful what you ask for, because if you think our trading partners are just going to sit there and say, oh, I'm so sorry. No, they're going to figure out a way to come back and do the same thing. So in the end of the day, American consumers, the American manufacturing companies, those who export, I export, we're all going to be hurt. You know, that's why we have free trade agreements. That's why we get into these things like that. We got to talk to each other. But you know, when you listen to this thing, and I agree with you, a lot of it could be bluff just to scare them, you know, to do that. That's how it works. Thank you.
I completely agree with you that the debate on the economic impact of the tariffs has been grossly simplified. So I think there's no question about it. Tariffs will reduce growth. The question is, will it increase inflation more or decrease growth so much that inflation will slow as well because growth has been reduced by so much? And yeah?
Yeah, no, I just want to say one other thing. Is I do a lot of work on Capitol Hill.
Yeah.
And up there we've done it for free trade agreements and I've worked with the White House, both Republican, Democratic White Houses and also U.S. Trade Rep's office. But when I go and sit with the members of Congress to talk to them about trade issues, or we got trade legislations come up, make them understand, that on one respect, I said, you got to remember that bananas, I love bananas. I've spent a lot of time in Colombia and Ecuador with bananas. But bananas, we don't grow bananas in the United States. All those bananas coming in are on trade agreements. So be careful what you wish for. Same thing with coffee. The only place that grows coffee in the United States is in Hawaii. I don't think that in Vietnamese has got the best coffee in the world. Trust me, right? But I don't think that the American public would sit there and think about that. First of all, Hawaii could never satisfy the entire demand of the coffee drinkers in the United States. So you look at these commodities that are like that. And also, as I tell the members of Congress, do you have a Walmart in your district? Oh, yes, of course. I said, your constituents like Walmart? Oh, we love Walmart. I said, but they hate trade. They don't want to do anything with trade. They go, yeah. I said, you realize that 85% of the stuff that's sold in Walmart is imported. Oh, so be careful what you ask for. On one hand, I don't want to trade with them. I love going because I get good deals on that import. So it goes back and forth.
So having worked in 2019 in the White House, I'll give you a little bit of glimpse into the policy thinking that goes into selecting what's going to be tariffed. So there are algorithms that economists would create in the White House in separating the tranches that's going to be tariffed. First, on goods that's least impacting consumers. So that was the thinking going into that 2019 multiple waves of tariff, which is to start with goods that do not directly affect consumers. So it's the last tranche that are purely consumer goods. So I think if Trump was serious about slapping on tariff, he's going to go with that algorithm again and start with things that's least impact consumers first, but more toward his goal of bringing production back to the U.S., which I don't think will work. I think that, my bottom line is tariff is not going to achieve what he said he wants to, which is to bring production back such that it's a net growth enhancing policy. It is going to be a net negative policy. However, I think that the price increase from tariff will not ultimately show up in CPI because the importers have to eat all the cost, and they can only partially pass it through to the wholesaler. And by the time it gets to retailer,